Good afternoon, everyone. Thank you very much for this invitation. I'm very honored and happy to be here. So today I will present the key developments shaping the European steel market. I will cover recent trends regarding steel demand, production, trade, prices, market distorting practice as well. But for these presentations, I will focus specifically on Europe, but I want to open a bit with some slides on the global situation and understand what are the bigger trends happening in the global steel industry, because these are important to understand what are the dynamics that are now challenging also the health and viability of the European steel industry. All these insights that I will present today will be published also in the Steel Outlook, which is our publication at the OECD. And we present, of course, all the trends that are taking place in the global steel industry, including, again, demand, production, prices. So I invite you to read that as well. First, let me introduce you the OECD. The OECD is an international organization that have different forums and committees, offer a platform for governments to discuss the most pressing issues in our economy. And the work on steel is mostly done by these two bodies, which is the OECD Global Forum on Excess Capacity and the OECD Steel Committee. So the Steel Committee areas of work revolve around monitoring the market, providing also very specific analysis on government interventions, decarbonization, trade issues, steel raw materials, other topic as well. It has currently 30 members, 7 participants, but also a very strong engagement with the Steel Association from all over the world. The GEFSEC has been established in 2016 under the framework of the G20, offer a platform for the 28 members to share information on steel developments and enhance cooperation also to resolve the issues of global excess capacity. In fact, during the time when the GFSEC was established, the steel industry was in the mid of a steel crisis. During that time, there was massive surplus in steel production capacity worldwide, largely driven by China. The crisis led to significant job losses, financial constraint for many steel firms. And against this background, the GFSEC was established to find common solutions to the problem of excess capacity. And as you may know, these efforts help to ease the intermediate pressure, but these structural imbalances have re-emerged. And today, excess capacity remains one of the most pressing issues in the global steel industry. Global steel excess capacity is projected to reach 700 million tons by 2027, which is more than the total production of all the GFSEC countries combined. Steelmaking capacity is continuing to expand at a rapid pace, but demand is not following. And we see this increasing capacity happening in regions that have already experienced surpluses in the past. And if we look precisely at the capacity coming into stream, by 2028, global capacity is expected to increase by 4%. Asia is the region where most of this new capacity will come. And most of it will also be of blast furnace. So not only the issues of increasing excess capacity, but also putting in the market high emissions capacity that is going to slow down decarbonization efforts. And when we talk about excess capacity, it's impossible not to understand what are the root causes of it. A large part of this excess capacity is supported by non-market policies that facilitate investment in capacity, but also keep the unprofitable firms in the market. And across regions also, it's very clear which are the countries that subsidize the most. These are mostly non-OECD economies. China currently is the largest provider of subsidies, and it provides an average of 10 times more subsidies than countries in OECD economies. And there are multiple instruments that the government can use to support the steel industry. This is a graphic that simplifies a bit this mechanism. At the center, you can see that the steel producing firms, which is the main recipient of various subsidies. Red arrows on the top, these are the direct way in which the government support firms. These are instruments such as government grant, tax incentive, provision of below market borrowing, all data that we are able to capture fairly well. But there is a lot of support, which all the other arrows around there, that is very often hard to capture, and because there is a lack of transparency, or because it's also underreported. For instance, the provisions of energy land, raw materials below prices, these are hard to quantify because there is limited transparency and there are varying regional pricing mechanisms. So these form of support escape what is the traditional subsidy classification, but they have a significant impact on the production cost, on the competitiveness, particularly in the steel sectors. This is just the top of the iceberg, because there is a lot of instruments that cannot be measured, such as political relations that we see a lot between state-owned enterprises, for instance, or other implicit support that allow for preferential treatments. And these are not labeled as subsidies, but they distort the market just as much. And not only excess capacity is damaging the steel industry, but also the profitability of steel firms is being damaged. This chart shows how operating profitability in the global steel industry has evolved over the past 2 decades. So operated margins peaked in the early 2000s, but have been trending downwards ever since. The median margin has fallen from 10 to 12% to 7% today. And both the upper and lower quartiles have seen decreasing profit, meaning that even the firms that used to be big, that the profits a lot, are now losing a lot of profit margin. And of course, excess capacity play a key role in this. It lowers steel prices, deteriorate the profitability for the firms, and it makes also increasingly difficult to for the firms that are unsubsidized to compete with these firms. So globally, margins are being pushed down by excess capacity, widespread subsidization, and Europe feels this pressure even more severely because in this environment, Europe is also challenged with weaker demand, higher energy prices, declining production, and declining steelmaking capacity. That's what I'll turn now. So the European steel sector is expected to remain under pressure in 2025. Here we have the Purchasing Management Index that shows that European producers of steel-intensive goods do not expect demand to recover in 2025. In fact, a reading above 50 means that manufacturers expect activity to expand. And when it's below 50 means that they expect it to contract. And looking at the lines, we see that there is a divergence between regions. In red, we see Asia, which has stayed mostly above the 50 threshold, suggesting that manufacturing activity is continuing to expand, supporting also stronger demand for steel. In contrast, the blue line, the European Union, remains well below 50, and that's for most of the period. That indicates that downstream steel demand in Europe is remaining very weak. In fact, in 2025, steel-related activity in Europe have been sluggish across most of the sectors, which are cutting back their own activity and therefore also requiring less steel. And these include mechanical engineering, domestic appliance, construction, automotive especially have seen important production level decrease. And because of this decline in steel demand, prices are also expected to remain quite low in the coming months. This chart shows the purchasing management expectation for steel prices inputs across Asia, Europe, and the United States. Again, the 50 threshold means that when it's below that, it's the price expectation is that the prices are going to fall. Now, in Europe, expectations were consistently above the 50 threshold throughout 2023 and 2024, signaling that there was relatively stable prices for steel. But From early 2025 onwards, sentiment began to weaken, and by July 2025, now European manager expectation had fallen below 50, and now indicating that firms anticipate declining steel input prices. They will continue until the end of the year. And it's not just prices and demand that are falling in Europe. Steel production has fallen since 2011 by about 23% between 2011 and 2024. This was also accompanied by a contraction in steelmaking capacity, which decreased by about 16% between 2008 and 2024. In the first 10 months of 2025, steel production decreased by about 3.4%. And this decline is both across production, but also steelmaking capacity. It doesn't reflect only the weaker demand. It also highlights a struggling market where steel producers continue to face very important challenges. And one of these challenges is the high cost of electricity and gas that European steelmakers have to bear. So these two charts illustrate the scale of the energy gap between European Union, the United States, the MENA region. Here I use the MENA region because this is becoming an important steel producing and steel exporting region. MENA region, the steelmaking capacity has increased by 75% between 2010 and 2024. And the expansion is also facilitated by low cost of energy and gas that are subsidized by the state. And for countries in the European Union, it's becoming increasingly complicated to compete with these countries. Just to look at the gas, for instance, in the European Union, gas costs around $18 per million BTU. In the United States, it's roughly 5 to 6. But in most MENA countries, the costs are much lower. Qatar and Saudi Arabia pay less than $2 per million BTU, and Algeria fall below the $1 per million BTU. And on the right, the same is valid for electricity, while European steel makers pay more than $200 per megawatt hour. US producers pay closer to $80. And in MENA countries, all these prices fall below 40. And in some MENA countries, electricity is 10 times cheaper than in the European Union. So against this backdrop of high cost, weaker demand, Europe's trade position has also continued to deteriorate. While China's exports are increasing very rapidly, the share of export of other important steel producers is collapsing. European steel exports have fallen quite sharply, and now they are about 80% below their 2020 level. And this is not just a temporary dip. It is a structural decline that has continued over several years now. And at the same time, the issue is that Europe is becoming also increasingly reliant on imported steel. Imports reached more than 69 million tons last year, and that's about a 22% increase since 2020. And again, Europe's worsening trade position cannot be explained by the domestic factors. It is increasingly shaped by the global dynamics that are putting additional pressure on the European market. And this graph, it's clear what is the country that is causing some of these issues. In fact, export surges from China and ASEAN are crowding out the traditional suppliers worldwide. And much of that displaced steel is now flooding into Europe. And this pressure is also amplified by the fact that countries like the United States and Canada are taking very strong trade actions against this cheap steel from Asia, which means that even more of this excess capacity is being deflected toward the European market because there are fewer restrictions. And this is precisely where Europe faces a vulnerability. While redirect imports are increasing, Europe's own trade response has remained relatively limited. In fact, in 2024, out of the 81 anti-dumping investigation, Europe only initiated 4. And in 2025, Europe only initiated 5. So the question is, how many ways steel imports is penetrating the European market in this moment. The first one is direct imports. I mean, we see that increasing volume of cheap steel coming from China and several other Asian economies that add immediate pressure to European producer. Between 2020 and 2025, direct steel imports from China increased by 178%. But this is just one of the ways in which we see these channels of imports. The second one is also in embedded exports. So excess capacity upstream is now moving downstream into steel-containing goods. Things like machinery, appliance, automotive parts, meaning that there is more indirect steel that enters Europe through steel product that is not captured by the traditional trade defenses. Third channel is the crowding out effect. So as Chinese steel flow into Asia, into Middle East, into Africa, Latin America, local producers are pushed out of their own market and end up exporting more aggressively towards Europe. Fourth one is comes from Chinese investment abroad. We see that in recent years, China has invested heavily in steelmaking capacity in ASEAN countries, and now ASEAN countries are becoming important new export hub, and steel producers in these Chinese firms increasingly end up exporting towards Europe as well. But these are just the primary channels that we see, but there is also a second set of channels, which is the one that are driven by trade policy. One, for instance, happens when there is a product modification. So when producer makes small adjustment to the product, such coating, chemical composition, so the product fell outside the scope of existing European trade measure. Another route is through circumvention. Steel is shipped through intermediary countries, often with minimal processing, specifically to bypass the European tariff and investigation. And finally, we are seeing a lot of trade deflection. As I said before, where markets like the United States and Canada introduce tough measures, steel that would have gone there is there redirected towards Europe. And because the EU currently has relatively fewer restrictions, these, of course, flood the European market. And taken together, this channel explains why Europe now is facing such sustained import pressures. And the surge is not coming from a single route, but as you can see, there are an entire ecosystem of direct, indirect, and policy-driven channels. And this is also why we see the European Commission considering a stricter measure towards these cheap imports. But these challenges also underline why international cooperation is crucial. In fact, no single economy can address global excess capacity on its own. These drivers are transnational, and so the solution must come from international dialogue. And under the framework of the Global Forum on Steel Excess Capacity, members have identified 3 key areas where there is the most need for coordinated action. The first one is monitoring. So ministers asked the forum to deepen the work on no-market policy and practices to understand what's going on outside the GFSEC economies, monitoring anything related to subsidy, financial, public financing, new steel project coming into streams. And members also are going to share information between them and start developing also indicators that help define these unfair practices. The second area is boosting the effectiveness of trade action. Members agreed to exchange experience on tools like melt and pour, to improve also the detection of circumvention, to better understand which type of trade measure are more effective than the others. And this is also include sharing data, methodology, and practical enforcement approaches so the country can strengthen their toolkits when it comes to trade action. And finally, the third area is collective actions. So ministers committed to developing the foundation for a comprehensive framework. And the goal is to get a framework by June 2026. This will involve coordinating trade actions among GEFSEC members, where possible, of course. This will help improve transparency and also ensuring that the global steel supply chain operate on market-based principle. There is also a strong push for increasing the GEFSEC membership, including through observer status, so the more economies can contribute to the solution instead of reinforcing the problem. And taking together all these commitments really signal a shift. So the GEFSEC is moving from a period of diagnosing the problem to really building a coordinated policy response. And the next 12 months will be critical in shaping that collective framework and also supporting a more stable market-oriented global steel environment. So just to conclude, the picture is that emerged from our analysis is that the European steel industry is facing multiple challenges. Demand across key downstream sectors remain weak. Price expectation have turned negative and production has contracted further this year. At the same time, European producers also remain facing continuous challenges related to cost disadvantages, particularly in terms of electricity and the cost of natural gas, compared with other competitors in the MENA region. And these structural challenges are also now being amplified by the global development. So Europe's trade position has deteriorated sharply, not only because of domestic weakness, but also because of the international environment. Export surges from China and several other Asian economies are displacing the traditional suppliers worldwide. And stronger trade action in other markets are also redirecting more steel towards Europe. As a result, Europe is absorbing growing volumes of low-price steel at a moment when its own producers are struggling with a lot of challenges. Now, looking ahead, this pressure are likely to intensify as global steelmaking capacity continue to expand. So addressing the global excess capacity is a core objective and will require sustained international cooperation, greater transparency, and also meaningful policy reform to restore the level playing field. Thank you very much for your attention. All the information, again, will be presented in the 2026 Steel Outlook. It's going to be updated, of course, but you can already read the 2025 version of the Steel Outlook that was published in May. It contains important information on what I talked about today, but at the global level. So we are looking at the global steel industry. I will stop here and thank you for your attention.
Thank you so much, Luciano, for a very important topic here. I have a very small question to you regarding the production in Europe. You told that like this year, obviously it was a bad year and production is still contracted. But with the safeguard measures next year will be more tightened. We expect that quotas will be cut, we expect higher duties. Do you believe that it will support steel production in Europe and it will reverse its downtrend?
Thank you very much for that question. I think it's one of those questions that's very hard to respond because right now, as the safeguards proposal is looking, they're going to be much stronger trade measure, which is a positive thing for European productions. So we expect that to positively impact production in Europe. This is said that, as I mentioned, there is a lot of challenges that Europe is facing. It's not only imports, but the fact that energy prices are so high. If the European Commission doesn't do anything about that, it's probably going to cause, again, the issue of low production in Europe. And it's one of those challenges that requires a lot of will from all the members and from the European Commission. So we have to wait and see.
Thank you. Do we have any other questions from the floor?
Thank you for your presentation. Overcapacity is the most significant problem facing the global steel industry. And while all discussions are focused on how to increase the demand, the EU Commission reports, namely environmental and socio-economic impacts of circular economy transition in the EU steel sector, published last month, indicates that circularity is likely to lead to significant consumption reductions in all steel use areas. Given this possibility, what do you want to say about the future of steel industry, currently under pressure of overcapacity, or did we reach to the point of no further growth in steel industry? Thank you.
Thank you very much. I think that's a very interesting question. Does circularity will impact steel demand in Europe? That's also a big question. It will impact actors differently, I think. Steel production will be impacted in terms of, we think that BOF probably will be the most impacted route when it comes to production. When it comes to demand, this is hard to say. And currently we don't have any model or economic model, but this is a question that European delegates at our of course, events always ask, and it's something that we are still have to look into because we need the data, we need more data to respond to that question, and the data is not yet there.
Thank you. The last question, I think.
Thank you very much, Luciano. You mentioned that European producers are under pressure and that there will be tougher safeguard measures coming up. I know that this is going to be a political question, but I don't want a concrete answer. I just want your best guess. Do you think the European Commission will have will grant any exclusions, exemptions, or improved conditions to the countries with free trade agreements with the EU after the negotiations to be carried on?
It's a very on-point question, but unfortunately, I cannot answer to that question because otherwise I'll be fired. So I won't answer to that one, but I think it's a very good point. And you know, we always talk with the European delegations, and they talk about these challenges. And when it comes to what is going to happen, not even them can actually answer precisely because there is a lot of confusion, I think, also on the other side. But I will just stop here, not add any other points to that. Thank you.
Thank you so much. Hope you enjoyed the session. So, ladies and gentlemen, we will have 10 minutes break right now.